right, so my presentation is called, and my thesis is called, On Payday Loan Principle, Mick Mulvaney and the Bounds of Reasonable Debate in Consumer Financial Protection. So I start with this. This is a quote from Mick Mulvaney, the current acting director of the Consumer Financial Protection Bureau, who says, "Despite what you might have read and despite what you might hear today, I'm pretty sure I'm not the devil," etc. So, Ben, what's your thesis about? My thesis is an appraisal of changes to the regulation of payday loans under the Trump administration, specifically under the leadership, under CFPB's leadership from acting director Mick Mulvaney, who was appointed in November 2017, whose term runs through today. And it's an effort to contextualize those changes in terms of the history of the product and its regulation, in terms of economic debates surrounding the product and the way it should be regulated, and in the context of the policy debate, including both policymakers, politicians, technocrats, etc., about how regulation should proceed. So, see this kind of as a triangle. So at the most surface level, it's about payday regulation and the way that that's changed. Then, in a broader sense, it's about CFPB. It's about the way that CFPB has evolved through the Obama administration, through the Trump administration, and looking forward to the future, how it will continue to exist in a kind of bureaucratic context, and how we will continue to see it exist, and the role that it has and the functions it will perform. And then even more broadly, we can see this as raising questions, really critical and salient questions about governance in general in the Trump administration and beyond, about how policymaking exists and works in 2018, etc. So, map of what we're going to be doing here. We're going to start with payday loans, what they are, their history, what the economic debate around them is, and kind of what the existing spectrum of policy prescriptions around them is, how payday loans were regulated in the Obama years under the leadership of Director Cordray at the Consumer Financial Protection Bureau, how that changed with Mick Mulvaney under the Trump administration, then what we can draw from that. Cool, so does everyone know what a payday loan is?
Yeah.
A lot of people know around here. I have to explain it often. So yeah, it's a short-term, high-interest loan collateralized by your next paycheck. You write a forward-dated check for the loan amount, plus interest, plus fees to come due at your next payday. Hopefully, you deposit the check, it clears, and then the lender deposits the check that you wrote. Everyone ends up happy. Again, it's a small dollar loan, average of $350 with 390% APR. It can be rolled over in the event that you can't actually pay back the loan. You pay a small fee, you get a new loan that covers everything that you owe, plus additional interest and fees to be due in another 2 weeks, right? So to draw a comparison, to kind of make real the 390% APR number, we can say that if you want to borrow $100 for 2 weeks, if you use a payday loan, it costs $15 to $20. If you were to carry a balance on a credit card, it would cost 58 to 96 cents. And just as a point of comparison, this isn't a very real example, but if you were to use a mortgage, it costs 12 to 19 cents. This is a kind of a false comparison. You can't get a 2-week mortgage, but just to make real the notion of what a 390% APR is compared to like 15 to 20% APR with a credit card, etc. And then with that in mind, we can kind of start to getting out what the whole point here is going to be. The outcomes of these kind of loans are that 4 out of 5 end up being rolled over, and that the amount that you have to pay in fees and interest exceeds the amount that you borrow for 60% of borrowers over the life of the loan, including it being re-upped. And why is that? Why are they so expensive? Because there is such extreme credit risk present in the market. So one paper involved researchers making what they called a non-profit payday lender, right? So they would lend out in a payday context and then try to not make any profit. They still had to lend at rates of, I believe it was like 290% APR, just to cover the losses from loans that were never paid back. So there's a kind of circularity to the logic here, right? That you have to have a high interest rate because so few people pay them back, and then because of such high interest rates, you exacerbate the problem of loans not being repaid. So, of course, we get the question of who needs $300 in such a way that they would turn to such a predatory product. Well, generally, obviously, we're talking about poor people. So these are single mothers, 25 to 44, making less than $40,000 annually. Generally, they are renters, they're not homeowners, they have no real assets that they can sell, that they can turn to. They also can't use other forms of asset-backed lending, so they can't generally use a car loan, an auto title loan rather, either because they don't have a car, because they would not prefer to risk losing their car. They generally also can't pawn, for example. And they also don't have, what they're using them on, I don't quite believe this number. It says that 69% use loans for recurring expenses, while 16% use them for one-off unforeseen expenses. But I think that this number is deflated for the number of people using them for unexpected expenditures, because I think there's a lot of people who have unexpected expenditures, use existing money that they have for that, and then take out a payday loan to cover recurring expenses in the background. So I think that this number here should be a little higher. And then, yeah, they have no other credit options. They generally are underbanked. They can't get a credit card. They can't get into a credit union, etc. Other options are just preferred. So, history of the product. They go back a long way. So by the signing of the Declaration, all states in the United States had a usury cap of 8%. That means a limit of interest that you can charge. But payday loans began to exist in the black market through other forms that evaded usury caps and otherwise. It was a very ugly black market, obviously, so that during the Progressive Era in the early 1900s, you had states passing this thing called the Uniform Small Loan Act, where basically it was a carve-out where they said, fine, we're going to keep usury caps, but then at the state level, we'll allow you to charge interest rates of up to like 42% for loans under $500, right? So you had an industry grow around that, and it seemed okay until the 70s, right? So in the 70s you had inflation, that pushed up against existing limits on interest rates. And also you had this Supreme Court decision in 1978, Marquette versus First of Omaha, where the court ruled that if you are a financial institution operating in headquartered in one state, but operating in other states, you only have to obey the interest rate limit of the state that is your home state, right? So you could move to South Dakota, where there is no interest rate cap, or to Nevada, and you could operate throughout the rest of the United States with no limit on the interest that you can charge. By the way, so like to draw a point here, we can see that this is becoming an increasingly federal question. Regulation largely existing at the state level, but the issue itself kind of growing to the federal level. We then see explosive growth in the product in the 90s. The kind of headline number is that by 2003, there were more payday storefronts than there were McDonald's and Starbucks combined. You might have heard that before. Why is that? It's for a lot of reasons. One of them, I'll bring up two. One is the rent-a-tribe strategy. Basically, large lending corporations would partner with a native tribe. They would move onto their tribal land, they would establish themselves there, and then they would operate throughout the United States, not having to really obey any federal law because they were associated with the native tribe, right? The other thing is the internet, right? So there was a lot of hope in the 90s and then throughout the dot-com era, and then more recently through the kind of app economy and the Internet 2.0 movement, that something about the internet, something about how smart we are with things like machine learning, etc., would allow us to make loans that are better, and that make loans that are cheaper and more affordable and improve the product. Really hasn't played out, in part because it's much more difficult to collect on loans given over the internet. Right, so the bottom line, there was a lot of hope that this would be a better alternative, but they've turned out to be basically just as predatory. So then we now arrived in the history at basically at the point where CFPB was about to be made. You might have heard of CFPB. This is around 2010 it was going to be made. I'll go into that a little more. But with regard to regulation, it was variable across states, mostly existing at the state level. Some states had outlawed payday lending. Others had basically no controls around it at all. And there was light federal regulation, but there was some, right? So you had kind of incidental regulation at the federal level based on other laws around loan disclosures in general, so like TILA and RESPA, if you've heard of those. Not about payday in particular, but touching on them. So throughout this kind of legislative history and throughout this history of the product, have they been helpful? Have they managed to help people? This is where we kind of talk about academic consensus on the product. And the consensus is that there really isn't one. The literature is mixed. So on the con side, we see that there's a very well-documented history of payday lenders breaking state-level laws, obfuscating loan terms, collecting on debts illegally, intimidating people, etc. Payday loans have been linked to bad financial outcomes. There are a lot of studies of states, natural experiments where one state will ban or suddenly allow payday loans, and then you can draw a comparison to neighboring states. Some studies find that they are associated, the availability of payday loans is associated with worse financial outcomes, including like increased bankruptcy, more delinquency on bills, etc. You also find in the literature that payday lending doesn't benefit from competition. So areas with a greater concentration of lenders also see higher prevailing interest rates. So there's clearly a market failure somehow. Also in the literature we find that banning payday lending outside of Air Force bases improved financial outcomes for people in the Air Force and also improved work outcomes, so like achievement in training. This is kind of one of the quirks of America, that it is actually illegal to lend to a military service member at an interest rate above 42%, and the law making that so passed with really broad bipartisan support. So be in the military, you get nice things. But on the other side of the literature, we see that various studies either fail to find these kind of bad outcomes that I'm talking about here, or they find improved outcomes, right? Because you find that when you have payday loans available, people stop turning to worse products like the guy on the corner who will lend to them, or overdrafting, for example, or bouncing checks, which is ultimately more expensive. We also find the product is very popular. 75% of people who got a payday loan approved of the one that they got. They generally see it as an unfortunate but necessary thing for them to do for themselves. They also prefer it to the alternatives available, like I was talking about before, like collateralized loans, like including pawning and also auto title loans. The one moment of consensus is that everyone here agrees that there is a lack of alternatives and that payday loans aren't as preferable, but what it comes down to is that there really is nothing better for these people. Cool. So now we're going to talk about the policy debate. With that in mind, where do people think we should move forward? One overarching point is that your party, the party that you are in, is a limited predictor of what your opinion will be. So on the left, among the Democrats, there certainly are people who say that you should ban them outright. This includes people generally from districts who don't actually depend a lot on payday lending, and also leftier types. Kirsten Gillibrand recently introduced a bill banning payday lending. Bernie Sanders, Joe Biden, Jeff Merkley, for example, some senators who have supported eliminating payday lending, they generally say that we should replace the payday loan system with a system of postal banking. This is where you have the post office, I see a head shaking. You have the post office engage in basic banking services like small dollar loans, like check cashing, like some small savings accounts that exist right now in Japan. It also existed in the US from like 1910 to 1950. Then you have the kind of group in the middle saying you should keep payday loans, let them be legal, but modify the loan terms and increase consumer protections. Keith Ellison is a more vocal supporter of this. This is basically what Colorado did in 2010. They had a very successful set of regulations introduced where you had loans had to have a minimum of 6 weeks to be paid back, and also the installed payments can't be more than 4% of your biweekly income. So the idea was that they were trying to extend loan terms and also have the payments be smaller and then not have a kind of massive amount come due at the end, which is more dangerous for people financially. Then you have people even in the Democratic Party who are very vocal about leaving payday lending alone. And by the way, this is generally people who represent districts that are disproportionately dependent on payday loans. Also, a lot of people from Florida, includes Debbie Wasserman Schultz, for example. They say these are unfortunate, but our district needs them, and so you should leave them alone. Cool. Now on the right, of course, we imagine that we would have a lot of opposition to federal intervention, and you do see that, but there's a kind of duality. So within Congress, within the elected representation, you generally are more likely to see people exclusively saying the government should stand out here, the government should leave these people alone. But then on the more academic side, within the kind of think tank world, we see some acknowledgement that there could be a role for limited intervention by the government to promote competition, more of a recognition of there being a market failure, and more ink being spilled, intellectual energy being spent trying to think of the way that that could look, broadly speaking. But we should note that efforts to deregulate the consumer space in general, and payday in particular, are not bipartisan. So a criticism, if only a not were here, among academics is that, and among the public, by the way, is that financial deregulation often depends on or involves collaboration from the left, right? Center left, etc. Tester votes for the recently passed change to the threshold for stress testing, right? But this isn't really true in the payday space. For example, there were 3 bills that were voted on in the Obama era that would have stripped CFPB of authority to regulate payday lending, or would have rolled back the rulemaking that CFPB issued in 2015 that we're going to talk about later. Those 2 bills, or 3 bills that were voted on, received, I believe, 5 votes from Democrats across 2 Congresses. So this really isn't a bipartisan effort. So the financial crisis happens. We have Dodd-Frank, and in Title 10 of Dodd-Frank, we create the Consumer Financial Protection Bureau. This started as an idea in an article written by a bankruptcy professor named Elizabeth Warren, where she proposed making a financial product safety commission analogous to the Consumer Product Safety Commission. This evolved into CFPB. CFPB under Dodd-Frank was given explicit statutory authority to regulate payday loans, but not to create a cap on interest rates. A cap on interest rates is usually what states will do to eliminate payday lending. It was a non-starter for industry from the beginning, even though President Obama actually supported having a cap on interest rates during his first run in 2008. To be clear, CFPB has enforcement authority over federal law around consumer finance. It can collaborate with state-level regulators on investigations that involve state and federal law, but it only has enforcement authority over federal law. This will be important later. CFPB, by design, is led by a single director, right? You don't have a board of commissioners like the FCC, for example. So regulations just go through that individual. They don't have to be voted on. CFPB also is financed by the Fed. The Fed finances itself through the yield on its bond portfolio. It's kind of funny, the Fed makes a couple $1 billion a year in yield from its bonds. CFPB just cuts off the first $500 million and takes it. So they don't have to ask Congress for money. This is a big point of contention. So Richard Cordray, the Attorney General of Ohio, was given a recess appointment to lead CFPB in 2012. He would ultimately be confirmed by the Senate in 2013. So what kind of steps did Richard Cordray take to regulate payday lending? Well, started slowly. He started by, even though it was an issue that he talked about wanting to cover very quickly, in 2013 and 14, his CFPB issued research reports on payday lending, categorizing it as very dangerous, talking about the kind of outcomes that people face. That 4 out of 5 number that I talked about before for loans being rolled over came from that report. Throughout the first couple of years of CFPB, they took enforcement action only against the most flagrant violators of federal law. So for example, they took an enforcement action against a lender that had very clearly violated the cap on interest rates to service members, etc. And then 2015 was kind of the flagship year, right? So in 2015, they announced the preliminary rulemaking. We'll talk about what's in that next. But just in general, the way that federal regulations are promulgated is that you first issue a notice of proposed rulemaking. So you say, this is what we're going to do. You then receive comments for about a year or so. And then you issue your finalized rulemaking, right? So they released their preliminary rulemaking in 2015. From there, they accelerated the pace of enforcement. So I said before, they did 2 enforcement actions in 2013 and 14. They did 2 more in 2015. They then did, I believe, 4 in 2016 and 16 in 2017 before Director Cordray resigned. The rule was finalized in October 2017, and it was given a start date of 2019. So what was in this rulemaking? What was this set of rules that CFPB proposed for payday loans? Well, if the loan is under 45 days, if it's a short-term loan, the lender would have to make a good faith determination of the borrower's ability to repay based on their credit history and other outstanding loans. Or if they didn't want to do that, they could enter an alternate set of rules where the loan could only be up to $500, it could only be rolled over twice, and the person was only be allowed to be in debt under a payday loan for up to 90 days per year. And then for loans that are longer term, there was more lax set of rules. You could do the ability to repay determination, or you would have an alternative set of rules so you can lend up to $1,000. Repayment would have to come out to no more than 5% of your monthly income, etc. When the final rule was passed, only this part was cut, only the ability to repay determination for longer term loans was cut. So how did people react to this? Of course, very negatively. 12 bills were introduced to either reverse it, to strip CFPB of authority, etc., to condemn it. I think there was one passed that did just condemn it in a kind of non-binding way. Industry posted over 1 million comments. Remember I said that the CFPB would be receiving comments. A lot of them are just boilerplate kind of robo-comments. And a lobbying group for the industry, the Community Financial Services of America, said from a number that they got from a consulting firm that it would the ability to repay requirement would be so onerous on them that it would reduce their revenues by 82%. Take that as you will. These are lobbying figures from the payday industry. These are actually campaign donations. You can see them ramping up around Dodd-Frank's passage and around picking up again around the rulemaking. You can also see lobbying numbers across parties, right? So it seems that the industry was kind of pushing, trying to reach out to moderate Dems to restrict the amount, to restrict the statutory language that would enter Dodd-Frank until its passage. And then after the passage, they really just retreated back to their team, right? But the question that's relevant here is, did what Richard Cordray did fall within the spectrum of reasonable debate, right? About how to regulate payday loans. Well, from a historical perspective, I mentioned before that the regulation of payday loans was increasingly a federal question, right? Up to 2010, through then, it seemed, I mean, an outside observer could pretty readily guess that given the growth of the industry across the country and given the way that issues with it were increasingly national and required national attention, we would expect a national actor to respond, right? So regardless of whether we might praise the actions as being further left or further right, we can agree that they were within the historical trend of the industry being increasingly demanding of federal attention, right? We can then evaluate what Director Cordray did in terms of economic rationale, right? So, I mean, the research reports that CFPB produced, I mean, certainly they fell within a specific camp of the academic debate, right, of calling payday loans dangerous, but they certainly were within the bounds of that debate, right? The rulemaking, I talked about the policy prescriptions and the kind of spectrum of debate within the policy world. Some said you should get rid of payday loans, and sure, CFPB didn't have authority to do that. The rulemaking that they came to, which looked to extend loan life, right, and like limit monthly payments, limit incremental payments so that loans would be less dangerous, seems to kind of fall within the center-left, the kind of Keith Ellisons of the world that I talked about before. But again, certainly within the spectrum that I described. And then from a policy perspective, the actions on enforcement really didn't draw much criticism, which, by the way, is a big victory for CFPB, having been criticized in other areas of enforcement, like in mortgage lending, of regulating through enforcement, it was called, of kind of preempting regulation by enforcing and by punishing people for things they didn't know weren't allowed. Having evaded that is actually a big victory here. And like I mentioned, within the policy debate, the rulemaking was kind of center-left from the policy perspective. And from the academic economic perspective, I mean, it fits within the kind of prescriptions that we see in the literature where people say that loans extended over a longer period of time with less interest at each increment are safer. So then the Mick Mulvaney era in comparison. So President Trump was elected in 2016. His Treasury issues a report in July 2017 outlining all the changes they want to make in the financial regulatory sphere. So that includes things in the macroprudential space and the consumer side, but it was actually very light on CFPB. It talked about changing its funding structure and its leadership structure, but it didn't talk about payday at all. And it didn't talk about rolling back the rulemaking that had been published by them, or that had been proposed by them. So it was actually kind of unclear how they would proceed. You may have heard about this. Director Cordray resigned in November 2017. His thinking was that if he resigned, his deputy would become director until the Senate could confirm a replacement. This was challenged in court. The Trump administration nominated Mick Mulvaney to replace Director Cordray, and they won in court. So Director Cordray is actually Director Mulvaney is actually the acting director. He hasn't been confirmed by the Senate, and a full-time replacement hasn't been confirmed by the Senate. So he's just there in an interim role. He's also the director of the Office of Management and Budget. So a busy guy. Mick Mulvaney became acting director. So who is Mick Mulvaney? So he was a congressman from South Carolina for a number of years. First ran, if you watch C-SPAN a lot, you look at his appearances on C-SPAN, he said that he wanted to run to be involved in the healthcare debate. This was during the Obamacare era. He said in an interview, and in what would go on to be a very widely cited quote, that CFPB is a joke in a sick, sad kind of way. It is extraordinarily frightening, and it is one of the most offensive concepts in a representative government. A lot of people don't quote this, but the interviewer went on to say, well, sir, what would you like to change? And he said, well, some of us would like to get rid of it, right? He personally co-sponsored 34 bills aimed at, and I'm quoting myself here, by the way, weakening, reprimanding, substantially altering, or simply eliminating CFPB. They're actually enumerated in an appendix in the actual written work, so take a peek there. And he personally drafted 3 bills of his own aimed at weakening or substantially altering CFPB. 4804 would have limited the breadth of CFPB's investigations into financial firms. 4951 would have made it so that the director would have to personally sign off on any entries into CFPB's public complaint database. And 4737 would have provided federal backing for the rent-a-tribe strategy I talked about before, and also would have delayed implementation of the 2015 rulemaking. Right. So yeah, I mean, I included this just to show that there's any number of fun quotes from Mick Mulvaney about how much he just hates CFPB. Of course, he says, we don't need CFPB because it took over functions that were already being performed by various regulatory agencies. He doesn't mention whether they were performed well by those regulatory agencies. We did have a subprime housing crisis. So, this is a little more salient. This is the kind of, he sat on the Financial Services Committee, which Director Cordray reported to every now and then. I'll be petty here and say that Mick Mulvaney was present for 5 of the 6 hearings that Director Cordray attended, as if he really cared about these things and was willing to be there. So the general trend is that his questions got more pointed as time went on. So we first just generally asked, how will you ensure there's a balance between consumer protection, et cetera, et cetera. 2015, we're getting closer to the rulemaking. He tells a story about a woman who was dependent on payday loans and who needed them to survive. 2015 says, why are you focusing on payday loans? These are such a small proportion of the complaints present in your complaint database. Director Cordray I admit this is a kind of strange response. He said, well, there is an increasing number of voices in the faith community who are asking you to respond to this issue. All right. And then in 2016, in an incredible exchange that I encourage you to watch, Mick Mulvaney says, "Sir, Mr. Cordray, you are from Ohio. Ohio has not banned payday lending. Does that mean that they have failed consumers?" Director Cordray says, "I'm not going to answer a hypothetical." And Mick Mulvaney says, "You don't want to, it's not that you don't want to answer a hypothetical, it's that you want to be governor." He ultimately was correct. Director Cordray is currently running for governor of Ohio and did receive the Democratic nomination recently. So, power to you, Ray. So he takes office, but there's these hints at the beginning of a kind of moderate future. He presents himself as kind of a technocrat who will enforce the law and nothing more, nothing less, right? So in his first appearance, this was from the press conference on his first day, he says, "Elections have consequences, and CFPB will be run differently, but what we're not going to change is the mission, we're going to enforce the law." Okay, I'm just a technocrat. I am a conservative, I was nominated by a Republican, but I'm just going to do my job. Similarly, he says, and this is a favorite line of his, this is after he's been in office for a minute, he says, "I am not going to place down. We have very fewer people working here, and I'm just trying to be a good bureaucrat." On payday in particular, he was asked, "Sir, now that you're in office, are you going to rescind the payday rulemaking?" And he said, "Well, I don't think there's very much I can do about that. You know, it's already been sent to the Federal Register. I'm just going to do my job. I won't rock the boat, etc." So here's what he actually did. And by the way, I'm not going to talk broadly about his actions in CFPB in general. You can look in the written work about that. You can also read the news about that. It is exactly what you think. But on payday in particular, the first thing that he did is that he dropped 4 major lawsuits against some pretty flagrant accused violators, alleged violators, of federal law, charging APRs as high as 950%, withdrawing from people's bank accounts illegally without having disclosed that they would. Next, so he initially denied that he was involved in the decision to drop those lawsuits. He said that decision was made by career staff at the Bureau. He would later admit, when asked in testimony by Senator Chris Van Hollen, whether he was involved, and he admitted that he was. It also turned out that he dropped an investigation into World Acceptance, which had donated to his congressional campaign. A small amount, but worth mentioning. It was accused of similarly unsavvy practices. Also, CFPB didn't announce that they had dropped this investigation. We heard about this because it was mentioned in a press release from World Acceptance, who was, it is reported, surprised to hear that the case was dropped. He also, on the rulemaking, delayed implementation. He announced that he would provide waivers for financial firms so that they could not have to comply for another 2 years after 2019. He announced that he would support going through another rulemaking process, right, so going back to the drawing board, and he would support congressional efforts to eliminate the rule under the CRA.